welcome to Sectors Upclose. I'm Angeline Ong. Our focus today is on investing in utilities, and our guest is Amy Kong, CIO of Barrett Asset Management. Now, the poorest performing sector this year among the S&P 500 sectors is utilities, just behind consumer staples. Despite being traditionally a popular choice for risk-averse investors, this sector is up just under 4% this year, compared to the near 20% for the wider US market. Its current dividend yield is 3%, compared with 1.8% for the S&P 500. The largest company in this index is the renewables firm NextEra Energy. The rest, however, are mostly traditional electrical utilities, including Duke and Southern. The main question mark hanging over these companies is how the shift to renewable electricity will help or hinder their profitability in the short to medium term. So does this sector represent an opportunity to buy, or is its underperformance justified? For now, let's ask Amy Kong at Barrett Asset Management. Amy, do you think investors should take a second look at utilities?
Hi, Angeline. Thanks for having me. I think the short answer is we're holding off. Let me just take a step back and just provide some context. To your point, the utility sector has underperformed this year. In fact, looking back at the past 10 years, the utility sector has really only outperformed the S&P 40% of the time. And, to your question of why is that continuing this year, I think there are a couple of factors to consider. First of all, we have to consider the part of the business cycle that we're in today. As we all know it, we are, at least in the US, recovering quite nicely, quite aggressively, at least in the first phase of the recovery post the pandemic-led recession last year. And typically when we're in this kind of market, the appetite that we're seeing is really more of a risk-on appetite. And so defensives, utilities, which typically are defensive, which typically have steady, lower growth rates, good dividends, that's not the kind of area that investors want to be putting money in today. Secondly, I want to just highlight a little bit on valuation for the sector. Everything's gone up as we know it. And for the utility sector, right now, the sector is trading at about 19 times forward earnings. And that's relatively cheaper than the broader market at about 20, maybe 21 times. But when you compare that to the growth trajectory of the utility sector versus the broader market, I think it's less compelling. So just to give you some context, the utility sector is, again, consensus expecting it to grow flat to 1% next year versus still 9% for the broader market. So again, comparatively speaking, it's less sexy, less attractive relative to some of these other sectors that we're looking at.
Amy, with all this as a background as well, would you also say the big risk is that utilities are being squeezed by both high energy costs and the high cost of investment in renewables?
Yeah, it's a great question. And I think you're absolutely right. They are getting squeezed. Commodity costs have risen extensively, natural gas as an example. And to your point, there has been a lot of competition for that marginal dollar, more so towards the renewable space more recently. And I think as commodity prices remain elevated, that trend should continue. I would say, though, just in light of the fact that renewables still remain a small portion of net electricity generation today. And again, to give you some numbers, it's less than 10% when you think about wind and solar and the like, versus natural gas, coal, and nuclear are still, again, 90+% of the pie here. It's going to move towards that trend, but it's not going to be an overnight trend, as you can imagine.
So it's going to take some time. And how about the fact that we're in an upward or tightening monetary policy environment? I mean, these companies were traditionally seen as solid dividend players, but at this point in time, they're probably not going to look as attractive, right?
Yeah, I would generally agree with that statement. I think the dividend growth in this sector has been fine. It's a mixed bag. You see some 2-3% growth growers, and then you have some players like NextEra, to your point, being the largest. They have a little bit more flexibility, and they've been growing dividends at about 10% over the past 5 years, and that's okay. But your second part of your question is more key. It's this rising interest rate environment, and typically when we look back to history, when yields are below 2%, as they are today, it's okay. It's a good, okay environment for utilities. But I think the factor here is inflation running at elevated levels, 5%, 5.5%, and likely to remain so for the next couple of quarters. I think when you then look at real yields being in such negative territory across the board, that I think has weighed on utility valuation. And again, the fact that many of these are regulated, just don't have the pricing power. And I think that, again, has been actually an offsetting headwind for the sector. So that's another reason why we have not yet moved money into the utility sector just yet. Again, not making that defensive shift, not seeing that in light of the recovery still on very strong footing.
So for those investors who already have exposure to the utility space or thinking about it, what would you be your best advice going forward? Would you recommend selling, or would you recommend a broad ETF? What would be your best advice?
I think if you have it in the portfolios, I don't think it's necessarily a necessity to sell per se, but for that marginal dollar, thinking about investing back into the markets, certainly plain vanilla utility ETFs are plentiful. There's a lot of them out there. I would caution, though, that again, because of the dynamics of some of the components of the utility sector, you are seeing a little bit of a imbalance between some of the largest players. You mentioned Nextera. That's actually now 17% of the utilities sector weighting, and that's pretty high in my opinion. And Duke and some of these other ones that you've mentioned are about 5%. So you are again starting to see a little bit of that imbalance. I would probably guide investors to think about perhaps a thematic ETF, maybe water, maybe green energy, maybe renewables, to some of the comments we've made earlier. I think those areas might garner a little bit more momentum going forward. But certainly, the utility sector, the dividend part, as I've mentioned, is fine. And so again, if you're looking for stable dividends, certainly I would not be selling. But again, the marginal dollars could be going towards some of the more higher momentum thematic ETFs.
All right, we have to leave it there. Thank you very much. That was Amy Kong, the CIO of Barrett Asset Management. Before I go, here are some of the top stories in this space. Coal prices in China hit a record high amid a widening power shortage in the country. Thermal coal prices are now up more than 260% so far this year. With winter approaching, temperatures in most central and eastern regions have been lower than normal for the past 10 days, boosting electricity demand. Power rationing has been in place in at least 17 of mainland China's 30 regions since September, forcing factories to suspend production, disrupting supply chains and adding to factory inflation. Singapore's energy regulator has announced measures to safeguard the country's energy security as it struggles with soaring natural gas prices. About 95% of electricity in Singapore is generated from imported natural gas, prices of which are up about 500% this year. And reduced imports from a neighbour, Indonesia, are expected to last until the end of this year. The regulator said the measures will include providing standby reserves to ensure supply to struggling electricity retailers. And finally, Britain's energy regulator has announced that Royal Dutch Shell's retail unit will take on customers from 3 failed energy suppliers. The 3 had around 250,000 customers and collapsed due to soaring wholesale gas prices. Shell Energy has already taken on a similar number from one other failed supplier, meaning it will add 50% to its current customer base of 1 million. As of Monday, 12 British energy suppliers have ceased trading. And that is your roundup of the utility sector. I'm Angeline Ong, and this is Reuters.